I have some fantastic news for Canadian investors. Two of Canada's biggest oil and gas stocks reported earnings this last week, and what they said has absolutely changed the game for a lot of investors who were scared of what is happening in this industry, what the potential looks like, and whether or not there's real opportunity to invest in this sector at all. Welcome to Golden Arch Investing. My name is Liam. Today we're going to be talking about two of Canada's biggest oil and gas stocks, specifically Canadian Natural Resources and Cenovus Energy. On this channel, we've talked about investing in Canada the entire time. And over the last couple of months, we've really focused down on Canadian natural resources. Not just the company, but also just the sector, because there's been this massive shift in the Canadian economy. We've seen this huge split from the US economy, and we've seen Canada looking inwards to see what is it that we do best? How can we give ourselves an advantage? And what is it going to look like as a Canadian economy for us to invest in Canada? And overall, the story has been about building out our capacity for natural resources, taking advantages of what we already have, and of course, helping our energy industry. And because of that, and lots of other shorter term headwinds that had given us opportunity to invest in this space, I started covering this very, very often. I talk about these companies just about every week. And two of the big ones have been Canadian Natural Resources and Cenovus Energy. Now, Canadian Natural Resources, actually, I was looking at as a dividend play way back last year. I was talking about the potential here, the dividend they offer, the growth they offer, right? The resource base they have, the size they have, the acquisitions they've made. Canadian Natural Resources seemed like an obvious player. They were the number one in the space. They were the most defensive possible. They had the best asset base in. They had some of the lowest costs. It seemed like a no-brainer. And as a dividend investor, that makes a lot of sense. You want to buy no-brainers that are going to grow for the long term. Now, Cenovus, I stumbled on a little bit later, thanks to recommendations from lots of people who pointed out the undervaluation. The story with them has really been about the idea that their downstream, so their refining assets, just aren't up to par. The way they've operated them just hasn't produced the kind of income that investors expected, and so the stock was at a discount. The thing is that they've done a very good job of reversing this trend and of creating the opportunity for their investors to gain significantly from the turnaround. Over the last week, both of them announced earnings, and they've mentioned a couple of key points. But to understand those key points, we need to talk about the macro environment. Now, if you're watching this, you're probably pretty comfortable with the investing space. You probably know a little bit about the oil and gas space. Otherwise, you probably wouldn't have clicked on this video, watched this long. But obviously, we've seen some big macro trends play out this year. First one is being the trend of tariffs and the subsequent trend of recession fears. We've seen tariffs really scare a lot of economists, a lot of investors. It scared away investment into businesses. You can't really build a new factory if you're scared that there might be a 140% tariff on your products. You can't really invest into a new home if you're scared you're going to lose your job. And it slowed economic activity across the world. Here in Canada, we got this trend a little bit earlier than most of the rest of the world because we were involved in the very first tariff conversations with the US when they announced tariffs on us, the Mexicans, and of course on China. But we've seen this trend sort of globalize, right? It's gone around the world, and there's been a lot of fear of recession, which I think is valid. And we've seen serious GDP numbers. I mean, some of it's a little bit disingenuous maybe, but we've seen some seriously bad GDP numbers that have sort of reinforced a lot of investors' fears. But that story really had its zenith at the start of April. We're getting into May now, and we've seen a lot of softening. That trend has kind of calmed down. The crash that did happen has been recovered from, more or less. So the second trend has been the drop in oil price. Now, this came right alongside that first tariff trend. We saw OPEC do their first little move there right after Liberation Day, where they started to bring forwards production or to increase their production faster than expected. It was reinforced at the start of May when they announced that they were again increasing the pace of their production. Now, this looks to most investors like they're going to bring what was 18 months of production online in about 6. Which is a whole different story and of course brings a whole new set of challenges for energy producers. The main one being that the WTI price of West Texas Intermediate oil has crashed. I mean, we're talking somewhere in the 50s range compared to $80 a barrel not that long ago. The problem for many US producers is that their break-even cost is at about $60. And their ability to reinvest is crucial in the shale oil world, where they have a year and a half with one well until production starts to dip and they've got to drill a new one. Of course, in a world where oil demand has continuously grown for whole generations here, most of the time, these companies aren't just looking to replace production, they're looking to expand it. And we've seen shale oil dramatically outproduce everybody else on earth for the last 10 or so years as they've ramped that production right up and, of course, stolen a huge chunk of market share, making the US the #1 oil producer worldwide. However, many key players in the industry have started to comment about the idea of shale twilight. Now, that doesn't mean that shale oil will be gone in 5 years. Instead, it means that production cannot continue to grow simply because the geology does not allow it. There is not enough oil in the ground for them to extract like that fast at the kind of prices that oil's at right now. The problem is, the lower you drop the WTI price, the sooner that twilight ramps up. If you can only break even at, let's say, $60 a barrel right now, well, if WTI is at 80, then you can take a little bit of a lower grade well. You can drill something that's maybe not quite as awesome that breaks even at 70 and still make a profit. But if the oil price is below 60, now not only can you not drill those tier 2, tier 3 wells, but now you can't even continue to replace your tier 1 inventory, your top tier, your best product. And so a lot of American companies have started to look around. One of the big problems I've seen when talking about investing in oil and gas has been so many investors are scared about the long-term potential. They think that oil is essentially a bygone resource. It's like investing in cigarettes, right? Why would you invest in an industry that's in decline? And I think that there is some real valid arguments that other energy resources are much more sort of long-term growth that have real long-term potential to replace oil and gas. We've talked about some of those companies here on the channel, but there's generally two camps of thought. The one group thinks that you are going to see peak oil in the next 5 years. Let's call it 2030, at which point you see a plateau at about whatever level that is, and then decline. The other group thinks that you're going to see continued oil growth in demand until at least 2050, when you then see a plateau and a decline. Now, in scenario number one, oil and gas is a terrible investment. You cannot possibly be paying a forward multiple for something that will never return that to you. You're paying a PE of 11. Well, you need 11 years of earnings. And if oil's out in 5, that doesn't make sense. But if you're going to see oil continue to grow for 25 years, that PE of 11, 12, 13, 14, up to 20 maybe makes sense. And if those companies can grow, whole different story. Now, I think the answer will probably be somewhere in the middle. As usually in these conversations, both sides are going to be a little bit skewed and something's going to happen that they don't expect. And I think that right now, what we're really seeing in the industry is the potential for more longer term gains from specific industries and specific areas. There's, of course, the question of maybe natural gas becoming a much more in demand resource. There's the question of oil from places like Canada replacing coal in places like India, right? Where does the global south get their energy resources from? Is it going to be a big, large, sustainable, investable market like Canada, or are they going to continue the sort of illicit, let's say, trade with Russia, where they've managed to get a lot of their energy resources since 2022? Now, obviously, I can't answer all those questions for you, but what I can say is that my core investment thesis in this conversation here, talking about investing in Canadian oil and gas, is based on the idea that Canadian energy is going to become much higher valued than it was for the last 10 years. And that Canadian stocks, Canadian energy stocks specifically, are going to see much more investment into their area, into their infrastructure, into their assets, and therefore see a much higher premium than their US peers. And I think that the earnings we saw this week could be the start of that trend. And I would really love to share some of that with you. Now, let's talk at first about the two companies that really got my head spinning a little bit about this conversation. And the first one is Cenovus. Now, like I mentioned, we've talked about them here on the channel a couple times. They are an integrated Canadian player, meaning they have upstream, midstream, and downstream assets, but really we're focusing on upstream and downstream. They don't really own a huge amount of pipeline. They're not an Enbridge, right? Instead, they have a huge amount of production and a huge amount of refining capacity, and they ship it through lots of partners. They announced some pretty good numbers recently. 1.3 billion in cash from operating activities, 2.2 billion in adjusted funds flow, 983 million of free funds flow. Results were good. Upstream production increased to 818,000 barrels of oil equivalent per day. Downstream crude was 665,400 with a utilization rate of 92. Now, If you don't know anything about utilization rates and upstream refinery assets, you'd want to see that at like 100. We saw Suncor this week. I announced their sort of earnings. I talked about their stuff. They were like an 104 on some of their assets. 92, not as impressive. Here's the impressive part. Board of Directors approved an 11% increase in the base dividend, 80 cents per share annually, beginning in the second quarter of 2025. So right now, consistent with Cenovus's financial framework, the base dividend is underpinned by our growth plan and resilience at US 45 WTI oil price. That's the most important part of this whole story. There's two things they told us right there. One, they're increasing the dividend. So you might expect right now, at a time of uncertainty, like so many other industries, these guys to just sort of sit on their hands. Hey, we're not doing anything until we know what happens. We can't invest. We can't give out more dividends. We can't repurchase shares until we know what's going to happen, because we're at a crossroads. We don't know. Are tariffs going away? Are we seeing trade deals this week? Or are we going to see another big fight? Are we going to see war in parts of the world? Or are we going to see, peace in some of these major conflict zones? What's going to happen? We don't know. And so we can't really project forwards. Well, these guys don't have that fear. They're willing to increase their dividend. And they're saying that not only is their dividend protected at $45 WTI price, but also their growth plan, which means that they are willing to continue to invest and grow in their company because they see that they are good at a much lower WTI price. And that's thanks to the fact that they mainly are an oil sands producer. And oil sands are famous for having long life, high initial investment costs, and low operating costs. The best part for me is that this isn't the only really important, really good news that Cenovus gave us in this earnings. We also saw some of their numbers in the highlights, but the thing I want you to look at was the third bullet point there. They returned $595 million to shareholders, including $62 million through share purchases, $333 million through common and preferred share dividends, and $200 million through the redemption of Cenovus's Series 5 preferred shares on March 31st, 2025. So that's all in Q1, right? They repurchased $62 million in share purchases. They repurchased those. They bought back those $62 million. That's huge, right? Q1, we saw a lot of tariff threats towards Canada. We saw Canadian stocks dropping. $62 million is nothing to sneeze at. It's a big company, sure. They're generating billions of dollars a year. But $62 million indicates a little bit of strength there, right? They're willing to repurchase some shares. But look at this next sentence. This is the really, really, really interesting thing for me. The company subsequently purchased 10.9 million common shares for $178 million between April 1st and May 5th, 2025. That's crucial for two reasons. One, the number is way, way larger. $178 million compared to $62 million. During a 1 month period compared to the entire quarter, huge. They also purchased back 10.9 million common shares. They're proud of the price they paid. Okay, they're willing to announce, hey, earlier we saw 62 million. We have no concept what their sort of base price might have been. But if they can purchase, 10 million for $178 million, we know that they were getting a pretty good price. It's price in the teens somewhere, which is good for this stock. But also, they showed us this on their Q1 earnings. They were willing to announce between April 1st and May 5th that they repurchased all these shares. They do not have to tell us that yet. They are proud of it. And they're willing to announce and signal that strength to the market. Hey, we're willing to spend hundreds of millions of dollars at a time of uncertainty on our own stock because we see it as dramatically undervalued. Now, there's other things they mentioned in here, including their operational, efficiency. I think that's probably the best word, right? Their ability to get those downstream assets working the way investors want. We've seen investors reward the stock. So I'm guessing a lot of the language is making those larger investors, those big funds, happy with what Cenovus has been doing with that downstream asset base. Obviously, increasing production is important, but they are clearly showing that they're strong, they're well positioned, they're willing to grow, to invest in themselves, and they're not worried about the current price of oil or the current recession fears. They don't see demand dropping enough to sort of ruin their growth plans. They don't see the price dropping enough to sort of hold on to cash and worry about paying that dividend. They see strength. And you could argue, hey, management might be way off base here. But the thing is that they're aligned with a lot of their peers. So you'd have to say that all of the management of all of the Canadian major companies in this space are wrong. And I think the better bet is that they probably see stuff we don't. They see their own strength. They see the macro trends. They see that shale oil decline. They see the potential growth in Canadian infrastructure, they see the drop in WCS, WTI differential, and they're looking and thinking to themselves, we are happy right now. We're in a good spot. Let's move over to the second company. Now, this is the big dog in the Canadian energy space, the Canadian Natural Resources Limited. They are the largest producer of Canadian oil. They're the first company we talked about in the Canadian oil space because they're kind of the one out there. And they've had a little bit different strategy. They are an upstream player. They're a producer. They're just about as pure a play on producing oil as you can get in Canada. And they are a oil sands giant. They have made huge moves over the last year, 2 years, 3 years to just acquire as much oil sands assets as they can. And they look at these as if they are at a huge discount. And I think they have for quite a while. The real story I think that they gave us here is talking about their ability to continue operating. Now, they mention all sorts of things here. They mention some key things that I think also indicate that strength. Talk about their long life, low decline production. They talk about their world-class oil sands, mining, and upgrading assets. Talk about their capital efficiency. There's a important bit in the fourth paragraph here where they talk about their focus on continuous improvement, resulting in capturing cost efficiencies, right? And because of efficiency, they're able to cut back $100 million that was going towards their expenditures, their capital expenditures this year. And how now that they've cut that back, they're only going to spend about $6.05 billion, but they'll still do all the same projects. Hugely different language than a lot of their US or international peers who are cutting back on expenditures because they need to cut back. They're scaling back production targets. These guys are hitting their production targets. They are keeping them the same, and they are spending less money, which is actually a totally different story and very bullish. And of course, these guys, you see in the second last paragraph there, need to bring it up, just like Cenovus. Our business model is robust and sustainable, as our top-tier US WTI breakeven, defined as the adjusted funds flow required to cover maintenance capital and dividends, remains in the low to mid $40 per barrel range. Our balance sheet is already very strong, and we improved it further by reducing net debt by approximately $1.4 billion in Q1 25, as mentioned above, and maintained liquidity of approximately $5 billion as at March 31st, 2025, providing significant flexibility. Now, I think the story there is, hey, we are good down to $40 WTI. We can sit on our hands here. We can continue to operate. We can hit our production targets. We've got our capital budget over here. We don't have to worry about that. That money's already there. And on top of that, we're sitting on $5.1 billion of liquidity. So if we see other assets in the Canadian oil space that are looking like, oh man, maybe they can't sustain right now, who's going to be the first bidder? So far, at just about every turn, if it's in the oil sands, Canadian Natural is there with a check. They are looking to expand. And so what's the real story here? Well, I think the short-term investment story is that these Canadian oil sands assets are going to trade at a premium, and soon. Their low costs of operation, their long reserve lives, their low decline light speed, so they're sort of slow declining, long life assets are going to be valued at a premium very fast. I think in the next 12 to 18 months, we see huge investments in Canadian energy. And I think that investors recognize this. We have seen major names, like I mentioned Eric Nuttall recently, who talks about this constantly. He strongly believes that American oil money needs somewhere to invest, and Canada's going to be on the list. And what is the easiest way for them to do that? Well, it's to start investing in these Canadian companies. These companies that have already demonstrated their ability to grow and to become even larger and even more profitable at some of the most difficult times in recent memory. These guys made it through COVID. These guys are making it through the tariff threat. They're making it through the OPEC flush. They don't care. They simply do not care about what is happening. And so investors are looking at that, and they're going to start paying a premium, which means that us, retail investors, normal Canadians, if we want a piece of the pie here, it is time to act. I'm going to finish up by showing you a couple of charts because I think that we have already seen some really good indication that this trend is playing out right now. Now, the chart I have right here on the screen, this is again from FinChat, but it shows you the last 5 days. And I'm comparing the two stocks we've talked about, CNQ and CVE, which is Canadian Natural and Cenovus, respectively, with ExxonMobil, an American super major producer, and ConocoPhillips, another massive giant in the oil space. And look at the charts. I think we can all very clearly see exactly where those earnings reports came out, and you can see how investors reacted. I mean, Cenovus, obviously, huge jump, 14.5% over the week. They were up 1.1% as of May the 7th. So in 2 days, we saw just about 13.5% gain. Huge. Obviously, investors loved what they heard. They liked all the talk about operating efficiency. They liked the strength projected, the shares repurchased, all of that looked good. CNQ, we also saw, let's say a 7% gain since the earnings report. They're up 3, up to 10 for the week. Again, double-digit week at a time when tariffs are still there. We saw no progress on the tariffs between Canada and the US. We saw no real progress between the US and China. We saw no real indication that there was going to be a total change, and yet stocks up 10%. Compare that with the American companies, who also have some good news, right? They talked about things, right? The same sort of stories. Exxon is up 4%. So that same time frame where these guys grew 13 and 7% respectively, they grew 3. ConocoPhillips moved up 1%. So you are already seeing a significant increase in the valuation, the premium being put on Canadian oil companies in contrast with their peers. But you might be thinking, hey, this guy's a long-term investor looking at a 5-day chart. What is he doing? Well, let's zoom out and look at the year so far. And really, everybody can see that huge crash on Liberation Day, right? April 2nd. And I'll show you that on the screen here. We see where all these companies were sitting, and then we see, obviously, over the next 2 days, just bad news. As we saw, the US announced tariffs, China counter tariffs, OPEC flushed the market, all of the bad news just sort of combined into those few days. Well, look at the way the prices moved. We saw Cenovus drop about 20%. We saw Canadian Natural only drop about 10, maybe a little over 10, right? But only drop about 10, about half of Cenovus. We saw Exxon also down just about 10. And then we saw ConocoPhillips dropping closer to the Cenovus's numbers, so closer to 20%. So everybody dropped, and depending on which side you were on, right? The Exxons, the Canadian Natural dropped about 10, Cenovus and ConocoPhillips dropped about 20%. And then you see a very similar pattern play out for the next little while. As we see news events happening, we see, okay, there's a little spike here. Okay, back down. Okay, slowly grinding upwards. Oh, okay, we're slowly grinding downwards. And then we get back to this week. And you can clearly see, for the first time since the tariffs were announced, separation, where Canadian companies are clearly gaining and US companies are clearly not. And so, the real premise of this video is that Canadian oil and gas companies are going to see a premium much sooner than anticipated. Because they have the resilience to make it through this market, because things have gotten so bad, you are likely to see these companies get much higher valuations in the short term than we had previously expected. When we saw the first kind of tariff threats going on, we saw a lot of Canadian companies dropping and a lot of international companies holding steady. Now we're going to see a pretty opposite result. Now, of course, geopolitical events can change this whole story real fast. So if you're watching this 6-10 months down the road, maybe a whole different world is played out. And maybe this is completely off base. But I think that right now is a great time to buy into some of these assets. I mean, think about it. These are really high quality dividend payers who have great track records, who have great balance sheets, who have spent 10 years where all they could do was invest in efficiency and fix their balance sheets, and are now looking at real tailwinds. The conversation in Canada has finally really shifted towards actually allowing these guys a little bit more room. We see TMX online. We see LNG Canada coming online this year. We see Canadian projects being talked about a lot. At the same time as US Shale is decreasing, right? We see that the live, real-time decrease in production targets from US companies. And so Canadian oil is at this beautiful opportune moment where the price is low and the tailwinds are just aligning all at once. I think there's a couple key things you should look for the next little while. I think one of the big ones is if we see the promises of politicians during the campaign here in the federal election become actual policy. If you see actual nation building projects come online, which a lot of the premiers have talked positively about. I know I'm an Albertan, and right now the conversation about Alberta is hugely divisive across the country, but we've all seen the premiers talk about the things they want to happen, each in their own different ways, some with a little bit more tact than others. If you see those projects become policy, if you see things actually happen, expect a jump, right? Any sort of coastal tidewater opportunity for energy that's not just the ones we have right now, expect a jump in price. Expect, again, a re-rating of Canadian assets higher. Any kind of energy corridor or whatever they're going to call it, essentially pipeline, that is planned and then becomes policy, expect a jump. Any kind of continued bad news for US Shale, expect a jump in Canadian energy stocks. That's what I think is going to play out over the next little while. And so as an investor, it's now or never. These prices will not last for long. I am a dollar cost average kind of guy. I like buying slowly over time to reduce my risk. But even I have put a little bit extra money into Canadian energy recently because I think the opportunity here is asymmetric. The downside is capped. At the end of the day, these are solid dividend paying stocks, right? You get your few percent a year. You get your solid dividend growth, right? We saw 11% dividend growth, nothing to sneeze at as a dividend investor, and you can sleep well at night. Don't make them 100% of your portfolio, sure, but you can sleep well at night in the worst case scenario where they see none of these tailwinds play out and things just sort of grind the way they are and the price doesn't move. But the upside is huge. We are talking about these guys becoming tens or hundreds of billions of dollars richer over the next couple of years. We are talking about these stocks just exploding upwards. We could see, let's say in the range of a 2x in PE ratio for some of these stocks if the kind of money that has been avoiding this industry shows up. And on top of that, all of the opportunity in potential tailwinds, I just think there's huge opportunity to the upside. The downside is somewhat capped. That brings asymmetric potential. That's why we talk about it so much. We've seen these companies project strength through all of these tough times. I think the time is really now to be buying Canadian oil and gas stocks. Now, of course, all sorts of different opportunities. I am a little bit more comfortable investing in the majors at a time with so much uncertainty, but there are better deals on some of the smaller names. So do your own research. Always, there are millions and millions and millions of people talking about this stuff, right? There's an abundance of sources online. If you want to check out my stuff, I talk about these guys quite often. So there's probably a video on whatever company you're interested in. And for the companies that there's not, I've probably started working on it already because so many of you guys have just been sharing interesting names, interesting stories in the space with me. And of course, I love that stuff. So drop me a comment if there are other names you want me to look at. Canadian stocks, of course, are sort of my preferred area, but we're going to talk a little bit about some international opportunities that Canadian investors love. And so drop me whatever name you think I should look into and you want to hear about on the channel. And with all of that being said, thank you so much for watching this far into the video. I know that these kind of conversations often are very speculative. And so none of this is financial advice at all, but I hope you enjoyed it and I'll see you in the next one.